Welcome to the Broken Pie Chart Podcast, episode 227. I'm your host, Derek Moore, and with me is my co-host / semi-permanent co-host, Jay Pestrichelli, CEO of ZEGA Financial. Jay, what's going on today?
Derek, look, markets are up. It feels like everything's going on today. Like it's been an interesting week, month, quarter, half a year, all kinds of good stuff going on.
Yeah, I think that's an understatement. By the way, we do get emails, Jay, and I want to remind people, derek.moore@zegafinancial.com, derek.moore at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Financial's up to you to spell correctly.com. If you can't spell financial correctly, do Google it. I'm sure they'll help you out. Jay, all right, let's start here.
Okay.
Bloomberg came out with an article the other day. Did I read that right? The Nasdaq, Jay, is best 6-month start ever. Can that be true?
I mean, that's what the article says. I was a little taken aback by that, but yeah, apparently this is the best first 6 months for the Nasdaq ever. That's a pretty strong statement. And I don't know if that's the NASDAQ 100 or the full NASDAQ composite, but it doesn't matter, right? I mean, that's obviously a pretty impressive metric that this is a pretty strong market. And, historically, that seems to be a good omen for the rest of the year, right?
Well, all right. So if you showed somebody this and said, hey, this is the best, and by the way, the best on the graph, is this from the late 80s, early 90s? So it's the best ever, however long they put this out.
Well, as I'm looking at it a little closer, it is the NASDAQ 100, not just the whole NASDAQ. NASDAQ 100. Okay. So that helps explain some things a little bit.
Yeah,
yep.
So NASDAQ 100, but it's impressive because you think about the late 90s and the tech, the .com era. Those are really, really strong markets. And in fact, I think this one just topped it. If you showed me this, though, I'd say there's a lot of people would say, okay, market's up best 6 months. It can't go up anymore, or it's bound to crash from here, or it's bound to just stick in place. But I think you hit the nail on the head. Like a lot of times when markets are up this much early, it is a good, it's not foreboding. Can we say prediction of probability of future potential gains? I mean, what does this say, Jay?
So historically, it tells us that when you have starts to the year like this, you get continuation through the end of the year. Of course, it's not every year, right? But, way more often than not, something in the range like, maybe it's 80+% of the time that it continues, and maybe not at the same pace, but still, double-digit type gains through the rest of the year. And so, if you're someone that uses history as a guide going forward, you can't ignore this very strong start to the beginning of the year.
Human nature, and I think traders in general, part of this is I think a lot of people miss this move with the core holdings in their portfolio. And I think institutions missed it as well. Like we talked last week, Jay, about who had, I'm going to buy home building stocks at the lows. Like that's going to perform really well. There's tendency to say, all right, well, I was wrong, and now I have to wait. I'm going to stay in cash, or I'm going to wait until the market comes back down. I'm looking at, and this is the S&P in that same article, Jay. Since the 90s, by the way, 1995, 18.6% first 6 months in the S&P, 13.1% final 6 months. Remember, I've made that correlation between 1994, 95 to this period.
You have on more than one occasion. That is true.
But really, since 87, when you have the markets up, this looks like double digits. They're not all double digits the final 6 months, but there's no negative since 87, right?
Yeah, and let's keep 87 in perspective. That was obviously a unique year. For those of you who don't know, that was when the year that Black Monday was in October of 87. What was the percentage the market was down that dreadful day, Derek?
Over 20%, right? I'd have to look it up, but yeah.
Over 20%.
Yeah.
Yeah. I keep thinking 25, and maybe it was 22 by the time it was done. So anyway, that I think that skews the data a little bit. But you're right, with the exception of, following that, there's 1 year in 88 when the market was up 1.5% the next 6 months. All the rest, here's one at 7, here's one at 8. But you've got 11, 12, 13, 14, 15, 10, 11% up on all these subsequent years after the S&P is up by double digits. The S&P unofficially, I think we should say over 15. Are we up 16% at this point? Maybe we'll see when the numbers come out and total return and all that kind of stuff. So very strong first half of the year in the S&P, obviously, and that seems to follow through. So look, I don't know of anybody that's. And by the way, that would put us at all-time highs, right? Like if we followed through at another 10% from here, right? Quick math today, market closed at 44.50. That's a nice round number, right? If we could get another, 10% on that, that's about it's 48.95. Let's round to 4,900. That's 10% from here. That would be something right after last year to turn around this year and hit all-time highs. I'm not making that prediction, but it is one of those things that these numbers could support an argument for that.
They also showed just how strategists, and we'll talk about our predictions because it is July 1st tomorrow. We're recording this the last day of June. There's another chart that says topping targets. The S&P has eclipsed Wall Street estimates year-end projections. And I guess that's a little misleading headline. I suppose they mean right now the market is higher than what analysts had. But they have this other chart, and they said, okay, strategist year-end forecast for S&P 500 on 6/15/23. All right, Jay, this is a little misleading chart. Do you know what they're talking about here? Kind of describe this.
Yeah. Okay, so this essentially is they're charting the S&P against what strategists are forecasting for the end of the year value, right? So let's say, Derek, you were, you would say, hey, I think we're going to end up at 4,500. That would be your mark, and then that would be where we would chart. And now, if you change that number throughout the year, your number would move. If you said, well, I was 4,500, now I'm 4,800, then your estimate would go up. And so when you look at where the analysts, I'll say strategists or analysts are forecasting for the end of the year, I mean, it seems like it's around 40, 50 is kind of the average of where, according to this, as of the middle of June, where the analysts and strategists are projecting the market will go. I just said we're at 44.50, right? So that's, probably 400 points higher or 10% higher than what the consensus of the strategist would have said. Now, when you look back over time, there's plenty of times where strategists were projecting much higher levels. So strategists aren't always, sandbagging the number because they want to say, oh, I was hoping for 4,200, came in at 4,300. Great. It was better than I thought. That's not it. Throughout all of 2022, strategists were projecting much higher year-end targets. Through most of 2021, they were also projecting much higher targets throughout the year. So as the market was moving up, they were moving up their targets. So, I don't know, Derek, when I look at this, the first time I saw it, it was a little confusing as well. But essentially, as strategists are adjusting their end of year targets, they typically are a little more optimistic than where the market is going. But right now, they're actually still significantly lower than where the market is.
The other interesting thing is, I mean, we mentioned housing last week, but, coming into the year, I don't know if most people had information technology as being the best performing sector. And that was probably the worst performing sector the year before. So This year it's been, the quote, the Who song, "Meet the new boss, same as the old boss." It's information tech, not energy, that's driving things. Like, I don't coming into the year, everyone's like, "Oh yeah, it's going to be maybe flat to down. Earnings are going to be down, and energy is still good. Value is going to do well." Nope, it's the FANG stocks, and so, by the way, and this is why, great. If you own the S&P, which we like to own the S&P, and then we hedge it. Always be hedged there, and because you don't know, but it's like, this is why you own the whole market, because this is tough, right?
It's tough. Like this, what's happening right now, nobody really projected this. I mean, very, very few, I should say, would have projected something like this. I can't say nobody. I can't think of anybody. I mean, Tom Lee's one of the most bullish guys I hear from on the street. I'm not sure how he started the year. We'd have to take a look. I'm sure he's higher than everybody else, but I don't think I've heard 5,000 or 4,900 out of him.
I think he was pretty high.
Maybe now we do.
No, I think it. I heard him on, I think, CNBC, maybe December, and I think he had maybe a 4,700 handle or 4,800. He was definitely one of the highest analyst estimates on the street for sure. Morgan Stanley's been the low one. I think Morgan Stanley had the markets going back down quite a bit. They seem like they're revising.
Testing lows, right? 3,300, 3,500, kind of in that range. Yeah.
Yeah, I don't know if he's changed. I think the analyst at Bank of America said, "Hey, we need to raise the estimates a little bit." And I think the chart you were talking about speaks to that. Like, yeah, if the market's going down, they tend to lower the estimates for year-end price. If they're going up, they're like, "Okay, we gotta raise the estimates." So I don't know. Was there anything else in this, Jay? This was a pretty good art. I'll put a link to it. You may need a subscription for Bloomberg to look at it, but I think it's the first time you're looking at it. They let you look at one or two. I'll just say too, there's another thing. The bulls back in control, and we talked about it last week. Markets up over 20% from the lows, and they also have a relative strength index, so the RSI. And the RSI measures. So here's a little technical class for you. Your relative strength in a sideways market, when it reaches above a certain amount or below a certain amount, it tells you overbought or oversold levels. When you have a trending market, markets can remain overbought or oversold, uptrend, trend, or downtrend, for a long time. And so how you use this index, technical indicator, sort of matters depending on whether you have a trending market or non-trending market. But I think, Jay, the point of this is we rallied up over 20%, and we did get into the overbought territory in RSI. And I see this chart, and I see a lot of people saying, "Well, we're so overbought right now. This market's overbought." Like, I don't know, is it?
Okay, so we're going to talk about this. I'm happy to talk about the oscillator RSI, one of my favorite technical indicators. I'm glad you brought it up. Um, the little pullback that we had for that very short period of time between, say, June 15th through June 26th, right? It then it got out of the overbought range. Like we're not, by the way, after today's close at 44.50 on Friday, I do not believe the RSI it's not. It's 69. It has to be over 70 to be in the overbought territory. So this indicator says we are still not overbought. So I don't, from that technical perspective, the answer is no by definition. But feels like we've had a pretty good run so far, which, what? That's the emotional reaction to this market, right? So without putting numbers around it, that's an emotional reaction to it. That's probably always a bad thing, right? Don't be emotional when it comes to investing. So if you're looking at those numbers, it says no. Are we bullish? Yes, this is obviously very bullish, right? Strong uptrend, series of higher lows and higher highs. We're well above the 200-day moving average. Those are kind of some of the other technical, broad widely accepted technical indicators people use. So, all that being said, Derek, I think bullish trend, obviously, and I don't know, I can't really say overbought. The indicator doesn't say overbought. I will give you a little additional color. Sometimes using weekly RSIs is a little too short-lived. Using dailies is too short-lived. You want to use a weekly. When you switch to weekly RSI, also not overbought. It's at the top end of the range, but we never got overbought on the weeklies either. So no, we may not be overbought, Derek.
I used to change that into a little bit more of a trending indicator, and I would switch it around a little bit. But we'll save the technical analysis class for another time. Jay, this is interesting to me, and I want to talk about how sometimes, even if you pick the exact amount of earnings, sometimes it comes down to what the multiple is going to be. So right now, today it's a little different, but yesterday, using JP Morgan's guide to the markets and using their forward next 4 quarters of earnings, they're estimating the next 4 quarters of earnings to pull in $231.80 on the S&P per share. Okay. 43.81 was the price yesterday. You just mentioned the price today. That means a 14.9 EPS or forward PE multiple. Jay, what'd you say the market closed today? 44.50, right? So if I do
44.50,
yeah. Yep. So let's use that price. So we're trading on a forward basis. Analyst estimates, which can change, we just talked about that. That's about 19.2 times next 4 quarters forward earnings. This has been a multiple expansion this year, Jay. Last year was a multiple retraction. And I have to remind people, in 2022, the earnings came in about $218.09. 2023, I think there's like 2 more companies that are still got to report some numbers. No. It's closed. I think it was $219.70. So earnings went up ever so slightly, 22 to 23, but the market had a low of minus 22%. In other words, you can have earnings grow and the multiple stay the same and the market will go up. You could have earnings go up and the market multiple go up. Great. Market goes up for you. You could have earnings go down and the market multiple go up enough and the market goes up. Like, Jay, this is why, imagine you said, no, I know the earnings, but trying to decide, are people going to pay 20 times forward earnings or are they going to pay 15? This is hard stuff. This is why, you got to be right on so many things.
Yeah, when I think about the multiple, right? I've always said there's kind of two ways to measure the emotions of the market. One is implied volatility of options. The second is this multiple, because it tells you the appetite that investors have for future earnings. And when you have a higher multiple, it means they're willing to pay up more today than they were the day before for the same amount of earnings, right? And when that contracts, it means they're scared and they don't believe that the earnings will hold. And they pull back. And even if earnings stay flat, a reduction in the multiple means people aren't willing to pay up because the market came down. And so I almost feel like the multiple is the result of the market price, which means it's not the other way around, right? The multiple doesn't drive the price of the market. The multiple is the result of the price of the market. So what I mean by that is, when it's said and done and you take a look at, here's the price of the market, we just talked 44.50, and it turns out that if earnings are projected as they are, people have been willing to pay more now for those earnings than they were before. And to me, that's a gut/emotional kind of reaction. That's a fear and greed reaction. So people are optimistic. I mean, investors, I should say, are telling us they're optimistic by continuing to buy while the multiple is expanding. My take on the way the multiple.
I mean, it really is emotion. People Clearly, people were scared last year. Clearly. And this year, they're not as scared, and they're getting less scared. I mean, you can sort of see that. This is one of those frustrating things, though, for a lot of, I think, especially value investors, but a lot of investors, Jay, who say that it's a lot of reversion to the mean. So, okay, we're trading over 19 times forward earnings, and people say, well, that's too much. It's got to come back down. But we know that stocks can stay, we always quote it, stocks prices can stay irrational longer than you can stay solvent. I think that's the famous quote. But this is what I think frustrates a lot of people. And sometimes it doesn't make sense. Like it didn't make sense in the late 90s, but that run lasted a couple of years. It didn't make sense leading up to 2007, 2008, but it kept going. I mean, even Michael Burry in the movie The Big Short, like he was right, but he was wrong on his timing for a while. We was losing a lot of money. So I don't know. I think it's just one of those things, and it's misunderstood at times what drives markets, and that multiple is more important, I think, than people realize, Jay.
Well, I mean, it's kind of one of those things that people will use to gauge, is the market expensive or not, right? We maybe we're not all taught, but general theory about the markets are you want to buy lower and sell when it's higher. Well, guess what? When that multiple is low, it's telling you like, oh, I'm getting earnings at a discount than before. So fundamental investors will buy in those scenarios. But when you have a 20 PE, right, that's not considered cheap at all, right? That's actually above the average, which is what, like 16 and a half, 16.4 historically for the multiple of the market. So as a fundamental investor, you see the market running away from you and you go, wow, I kind of wish I was in it, but it's expensive and I am not going to pay more for the market. The challenge is it may not actually be more, right? You're maybe relying too much on things like the projected earnings. It's a projected number. That's not in stone. We don't know that number yet. We won't know till the end of the year. So this is kind of the complication about the way that you invest, and it's really hard to stay disciplined to that. If you were a fundamental investor, you should have loaded up last fall. I don't know what else to tell you. If you didn't, then you're not a fundamental investor, and that's hard to do. Of course, nobody ever wants to chase. So the opposite is to buy with momentum. And sometimes you don't want to be the last guy or gal that bought the market at the high. But, these are all this is why it's difficult to time when you're going to add or take money out of the market. It's why we don't really like to time the market at all, Derek. We like to be invested. Our clients have been invested all year. Unless someone said, get me completely out of the market, we left everybody in the market that was in 2020, 2021, 2022, and of course now 2023. It's because it's the easier answer. And it's right most of the time anyway. Maybe I went off on a little tangent there. Sorry, Derek.
By the way, Jay, 2025 earnings estimates are out, and who knows whether those are going to be 100% accurate or not. But 270.
You think there's a chance they're going to be 100% accurate?
They could be.
That's good.
They could be. I think so.
They could be.
So the revenue increase. So that's the top line. So you have revenue, and then your earnings is the bottom line on the earnings, the net income statement. 3.9% revenue growth and $270 a share. So that would be 20% above. Let's call it, if 2023 winds up being, let's round it off to 225. That's about a 20% increase over 24 and 25. 250. I'm a little suspect of these round numbers, though. 250 and 24, 270 and 25. And I think so. I don't know. We'll see what happens with this.
Listen, I mean, it's a guess anyway, right? It's an estimate. I shouldn't say guess. It's an estimate. So if you had 51.2, it would insinuate that I've got real numbers, and here's what my data kicks out. I think it helps protect, like, hey, it's an estimate, so we round, right? But I wouldn't be suspect of that too much. Although I would be suspect of anything that's projecting out to the end of 2025 at this point, right?
Yeah.
So you need a lot of factors that go into that math. But guess what? There's people and companies that spend a lot more time and money on things like that than we do, and You know what? Most of them don't beat the S&P, Derek.
They don't. They do not. Well, let's it is mid-year, Jay, and you and I did a show in December, and we did one the December of 21 as well, where it's sort of I'll call it a good-natured, we make our predictions for the following year. So it's mid-year, Jay. I think it's time we check in and see how right or how wrong we are. I'll remind the audience.
Oh,
yeah, I know.
we have
Well,
to?
I'm not going to link to the episode. I'm not going to do that. But I remind everyone.
Let's do it.
Like none,
Let's
like
do it. Face the music.
yeah, no, we have to face the music. And I'll remind everybody, we don't like a lot of things we do are systematic. It's long-term approaches that are systematic in nature. We either buy and hedge, or buy, but with buffers. We have different strategies, obviously they do different things. We sell volatility. We do it as a systematic thing. So, all right, but here's the deal. So we just have these conversations like everybody does. So you said the S&P is at 4450. Your year-end target, Jay, what do you think it was for the S&P?
I don't even know if it was 4,000.
No.
Well,
4350, Jay.
Oh, wow. Good job, Jay. That's good. I'll take it.
Then it implies a 100-point decline from here. So you're saying, now you said the high for the year would be 4,500 and the low would be 3,900. So
I'm okay. Well, the low is 3,800. We'll see the high. Maybe we're close. All right. That's fun. How about you?
Well, I was going to give somebody else's because they're better than mine, but I said basically 4,000 on the end of the year, 4,100 high, and 3,200 the S&P low.
You definitely were a little on the bearish side when we started the year. I do recall that.
That was before AI, Jay.
Well, the whole world has changed, apparently. For me.
Of course it has.
Yeah.
Yes. So
do we get to adjust? No, I know we don't. Keep going.
Yeah, I'm not going to go through all these, but Fed funds. Do you remember what you thought the end of year Fed funds would be?
5.5.
You said 4 to 4.25.
I don't even know my own guess. That's terrible.
You said the high range though would be 5 to 5.25. Isn't that where we are right now?
That is where we are right now, and that is the high of the cycle
so far.
Although,
let's see what they
so far.
Well, Powell has told us it is really, really important that we raise 2 more times. It's so important. We're not going to do anything in June. We're just going to sit around and watch.
Right. Even though June was nothing. So now you got me thinking, what do the probabilities look like for this? And looking at Fed funds futures, there's an 84% chance we go up by another 25 basis points on July 26th. So fairly certain that the market is expecting another increase to go to 5.25 to 550 as the upside range.
Yeah, that's fair enough. Jay, I was end of year 4.25, 4.5. That's a quarter point higher than you. I've already lost the high range though. I was 4.75 to 5. So that's done for me.
Okay.
What do you think you're
I feel like I'm 2 for 2 against you, but who knows?
Yeah, what do I know? So anyway, inflation change. What do you think your 2023 change was going to be? So your year over year it would come out in January, but for the December number, what do you think?
Yeah, maybe I give the Fed too much credit. 3.5 is. I'm guessing on my own.
You said 5.
No, hey, that's not. I think that's not so bad right now. That's not so far off.
No, what are we 4 something now year over year?
4.3. Yeah, something like that.
I was 3.05, which I think has a good chance of happening. And it's just. No, it's just math. Now, we didn't say core. I think core is still going to be high. But there are some higher numbers. So I think last June of 22, July of 22, those were some of the months that had really high increases. And so when you do a year over year, Now you start to, it's the base effect, they call it. So I think that'll be a little different. All right, let me do one or two more of these. GDP change, Jay. I was at 1.8% for the full year. What do you think you were?
Well, I do remember this because you mocked me
I did.
a little bit for my extremely bullish expectation. I think I was in like the 5 range,
You were
right?
5%. So
yeah.
Yeah. So
Mock away, my friend. I'm just
Yeah.
kidding. It's fine.
Yeah. By the way, you had here, I'll just say these. 10-year treasury, end of year, you had 3.5. I had 2.95. So you're right there, Jay, with the 10-year. And
Okay.
yeah, we had, by the way, we did
How about volatility, right? Vol's one of the ones that we like to predict, right?
Yeah. So you said 35.01. I said 33.05. And this was did we say the VIX closing high for the year?
I think so. The high of the whole year, the highest point it hits throughout the year. Yeah.
What was it so far this year? It wasn't that.
How are we doing on that? I think probably pretty bad, right?
Well, we were some of the lower ones on here. So among the,
I think there was a closing high VIX of 26 right now, 26 and a half. Looks like the high close of the VIX in that ever so scary March cycle, that March month that we had. So
yeah,
that was a little sarcasm.
All right, I won't go through the other ones.
26 and a half.
I'm sure we'll go through them at some point. I will say we had Bitcoin end of year number, and somebody actually filled in the answer. Who cares? That was Brett on our investment committee. So,
that wasn't you?
No, it wasn't me. I had a really low number. Of the people who put numbers in, I had a low number. I was the lowest by far. But that might be my answer next year because it doesn't matter, Jay, anymore. AI is the only thing that matters. All right.
Yeah, I think I've said this before on the podcast. I thought, this was going to be the crypto generation. It turns out it may just be the AI generation. We'll see. But when I think about what you're going to have to teach your son and I got to teach mine, it may be the AI is what they teach us.
I think so. All right. One quick thing. Student loans. All right. So Supreme Court came down today and they basically said you can't use the justification to wipe out either $10,000 or $20,000 per person based upon income limits. You can read the summary somewhere else. But I was thinking, so I have some thoughts on that, but also the student loan pause is ending. What is that? August or by October, I think.
October. I think it's October, yeah.
And I was trying to think through, I heard an interesting commentary that somebody said this probably reduces GDP by 9 basis points or 10 basis points. And other people say, no, I think it could be a little bit more. I don't know. I mean, I kind of forget, like people who have had student loans, they haven't had to pay anything for 3 years. And you'd say, okay, well, that's probably inflationary because that's money that they have to spend on other things. And some people have pretty high student loan payments. I don't know, Jay, do you think that hurts the economy at all? I don't know. Don't really know how to quantify that.
Well, look, I think there's the general assessment is that it will hurt the consumer discretionary spending, right? I mean, that's kind of the first thing that you assume when people have to start paying their loans versus having the cash in their wallet. It'll hurt discretionary spending. So I think that's the first thing. So maybe that helps slow down the consumer a little bit. I'm with you. Like this was definitely considered an inflationary action where people have more cash to spend because they're not spending it on a loan, right? I would love it if they were turning around and investing that money into the stock market, but the general consensus is that is not what is happening. Because wouldn't it be great if people just turn around and like, hey, buy yourself a share of SPY, once a month. Just pay $300, $350, $400 right now. $445 actually is the end of today. Buy yourself a share of SPY instead of spending it on something else. That would be nice. Now I feel like I'm preaching here. My apologies. But yes, so I do think discretionary spending is the assumption that will be the first to feel the hit of the loan repayments resuming.
And discretionary, of course, is consumer discretionary is speedboats versus toothbrushes, right? I mean, that's kind of the thing, and that's an extreme example, but it's like the stuff you need versus the stuff you want, or the stuff you don't.
I need a speedboat. Come on, need a speedboat.
What was the joke? Somebody who used to own a boat said, "How do you wind up with $1 million as a boat owner? You start with $2 million."
Oh, you start with $2 million. I thought you were going to go the best 2 days of owning a boat are the day you buy it and the day you
that's another good one too. Yeah, no, there's
that one too. You got a lot of boats in the desert where you are, Derek?
We have no, of course not like Florida, but we have some pretty big reservoirs that are really full from all the snow melt up north. So, people go out on those, but no, not really. We don't. Not unless California.
Don't need a speedboat. Okay.
Not unless we California kind of, the big earthquake comes and we wind up with beachfront property, but nothing yet. Yeah, I mean,
that'd be a big one.
I don't know. I can't really quantify it. By the way, I was just doing some quick math, and let's say somebody had a $500 a month student loan payment over 3 years. If, to your point, Jay, if they would have taken the $500 that they didn't have to pay and put it into the market, that's $18,000. Just if you didn't get zero, if you got 0% on your investments. Yeah, I mean that's
wow. And right now, you probably would not have got zero.
Well, you just told me this is the best 6 months to start to the year, and you would have been buying cheaper in 2022, dollar cost averaging, right?
Yeah, it probably would have been a good idea. But you bought a speedboat.
Do not buy a speedboat. No, do not. It's funny. Dave Ramsey's somebody who I don't necessarily agree with a lot of stuff he talks about. But I remember somebody passed me this thing, and I thought it was really good. He said, you should buy a much cheaper car than even your level of income. And you have to be comfortable driving up to a light and looking over to your right and realizing your car is much worse than the person next to you, even though your income is much better. And he makes the point, it's a depreciating asset, but people spend way too much on cars. Anyway, I don't often agree with Dave Ramsey, but when I do, I'll just say it. So there you go.
Well, the good news is I can disagree with that point, right?
You can.
I can.
On the student loan thing.
Anybody who knows me would agree that I would disagree with that point, but that's okay.
All right.
Continue, please.
The student loan thing is interesting, by the way. And it's, we're not going to get into it too much. I will just say, if you came up to me and said, okay, put your economist hat on, and if you wanted to design a structure that would allow a business, or in this case, let's say universities or schools, whether it's nonprofit or for-profit, to charge as much as they want and raise their fees or tuition really much greater than many, many other products in the economy. Like, how would you do it? And I would say, okay, you get unlimited government money. And then you also, it doesn't matter whether it's Sanskrit major, that's an ancient language. If you want to get your PhD in Sanskrit, I don't know if there's a big market for PhDs in Sanskrit. I don't know. I don't know enough about that market, Jay. But this is exactly the way you would do it if you wanted to make sure something costs a lot and keeps costing a lot. So I don't know. I don't think it would have. If you wiped everything out, what does it really change? I mean, nothing would really change. It's still going to be expensive. And with a lot of these income repayment plans now, why not just make tuition $1 billion? If they could do it with a straight face, they would. So I don't know, Jay, if you have any thoughts on that. But
well, as a parent of a boy that's about to go to college, I gave him the advice. You should take a loan for some of this because you never know if it's going to be forgiven. Even though I'm against that personally, I don't think it's the greatest thing for the economy. I would say you'd be an idiot to not take the money if they were giving it to you. So, I'm just in practice. I'm sure I'm not the only one that's given that, advice to their children, right? Take at least something of a loan. And then we'll see. Hey, if I got to pay it off for you later, I will, no problem. But Derek, I'm a big fan of, you value what you pay for, you value what you've, and payment doesn't always mean cash, but usually it does. I think it's one of those things that having I'm trying to think
Skin
of
in
it
the
right. You've
game.
probably uncovered something that skin in the game, but but at the right level, right? Like it's got to ridiculous tuitions can also be can also be damaging as well. So there's a lot that has gone around from the political standpoint around college this week, right? College loans and other pieces. So I feel like this is something that would be great if we could get right, because the end result is a better educated and better skilled economy. And I'm I'm going to stop myself before I say something that'll get you in trouble, because it's your podcast and not mine. So let's leave it there.
I will say that no, we'll leave that for other people. It's there's a lot of moral hazard that comes up with discussions like this, and you read some of the stories and you say, well, what about the person who worked an extra job, paid off their loans like last year? Like, all right, do they get money back? Or somebody 10 years ago who said, I can't go to college, and instead I'm going to go work. Or I could have gone to Harvard, but instead I went to made up university state, whatever it is. So economics is an interesting, and it's interesting to me. Economics is a dull science for a lot of people, but there's so much in here, whether, from incentives, moral hazard, just any number of things that are kind of fascinating. And in another life, I guess I would come back and start a university, and we would only teach Sanskrit, Jay, the ancient language. That's all we would do. We would just teach that.
Couldn't do it.
$1 million a year, so anyway. All right, Jay, any recommendations this week?
So I kind of went a little old school, but like we're in this period where there's not a lot of new stuff that's coming out, but there's some of them. My favorite, Sunny in Philadelphia is definitely on my Thursday watch list. I'm also watching Star Trek, but I went back and started watching some older stuff that I feel like I got left behind on. I feel like there's no big shows right now that are keeping my attention. So I am watching Boardwalk Empire. I am watching Peaky Blinders, and I am watching with my wife Suits. So there you go. I don't know if I would. They're all fine, right? They're all good. They're all entertaining. I've had some people tell me Boardwalk Empire is like one of their top 3. They put it up there with Game of Thrones and Sopranos. So I'm like, all right, I'll give it a shot. I've had trouble getting past the 3rd episode, but maybe I'll get back to it.
Meghan Markle was in that show. I did watch that show. My wife and I used to watch Suits when it was.
I think it's a good, it's a good one, right? It's like, who's really going to get bothered by that?
Meghan Markle apparently and Harry, Spotify dumped him, but apparently they paid him $13 million and they produced like 12 podcasts. So I figure this is 227. Spotify, we're at least worth 20 times that what they get, if that's the going rate. So good money if you can get it.
Yeah.
No, Suits is pretty
good. No, you're not getting $1 million an episode here, Derek?
Well, apparently something's wrong. I have the wrong agent. I got to talk to somebody about that.
Oh, yeah. Maybe you need a better coach.
Yeah, potentially. So I went back in time too. I went back to 2013. A movie called Rush. It's on Netflix right now. So if you have Netflix, you can watch it. It's got Chris Hemsworth plays. It's a Formula One based upon
racing
Niki
movie.
Lauda and James Hunt. And I do watch Formula One. I thought it was a great movie. It didn't do well commercially at all. I think it kind of flopped. But I know it was good. So it's on there. I recommend that one. Ford versus Ferrari too, if you like. That was a good movie too. That was
that's definitely on a recommendation list from me for sure.
That's the Le Mans race, so they drive for 24 hours, which is crazy.
Yeah. Yeah.
Like you're tired and driving at night. That sounds like an awesome idea, but they do it.
Yeah. Look, we're the Pestrichellis are a Mustang family. We've had Mustangs in our family forever, original owners of some of the 70s, right? First generation Mustangs and even some current ones. And it's like one of those things that, when you get connected to Shelby, and obviously the Mustang is a big piece of Ford's racing history. And so that movie was of particular enjoyment to all generations of people in my family. It's a good one.
Oh yeah, Ford, the Shelby. That's we went to the what's the thing? The auction in Arizona in Scottsdale.
Barrett Jackson.
Barrett Jackson. Yeah. So we went to that one year, and where we were sitting right near us was Steve McQueen's great grandson or grandson. I'm not sure which one it was, and they were auctioning off a Shelby Cobra that was, I think, one of only a few made of this type, and got quite a bit of money. So that was, yeah.
Yeah, that's a lot. That's a lot of fun. I went here in West Palm. There's in Florida. There's also a Barrett Jackson show. Not as big as the Phoenix one, or is it Scottsdale? Not as big as the one with you. Yeah, and a lot of fun to go do that. So much fun that like next year I'm like, I don't even know what I'm going to do, but I'm going to buy a car at one of these things just to go through the auction process.
Oh boy.
Yeah. Listen, you could buy anything. It doesn't have to be a $100,000 car. You could buy. We saw things going across the lot at $20,000, $15,000. I saw a nice Jeep, Derek. I bet you can upgrade your Jeep at Barrett Jackson next year if you want to.
Maybe I'll put mine up for auction. It's 15 years old. It's
or you could put yours up and then upgrade to a new one. Why don't you? You could roll that trade up and out.
I could roll it up and out. Yeah. No, I think that's a good idea. You also have to go to F1 at some point. I mean, it's in your backyard now.
Oh yeah. I mean, $2,000 for a ticket to go in person. It's not the cheapest thing to go see.
But how much is your enjoyment really? I mean, it's the enjoyment per dollar there that you get. I think.
I'm going to let you talk to my wife about that one. That sounds great. Derek's going to talk to you about enjoyment per dollar.
Well, all right. We'll leave it there, and next week we'll explore that.
Is that a new market ratio? let's work on enjoyment per dollar.
No, we're talking economics. It's utility theory. It's how many utils do you – it's like, the first slice of pizza has really high value, and by slice 73, it's like diminishing returns. So it's an economic concept.
Yes, I do remember that one. I do. Professor Derek still needs a sound effect on the podcast.
At some point, but no, it's and then you're instead of 2,000, it's your next best alternative, and you have to compare those two of what the most value is. So, I'll talk to your wife, Jay. No problem. We'll get it all squared away. All right, we'll explore.
That's great. I'd love to go to F1. That'd be great. I think. Austin
in October.
There's going to be yeah. I think we will be down there at the SIBO has a risk conference every year down there. So, I'm guessing there will be some folks that get to go to that race while we're down.
Yeah. Well, then there's the November one in Vegas, or you could always go to just Abu Dhabi, short skip and a jump for you on the East Coast. To not too bad there. That's a night race too. That's a cool one
for the weekend.
Yeah, not too bad. All right, Jay, let's leave it there. We'll come back next week and break down F1's upcoming Austrian Grand Prix this week in detail, and we'll see what the market does. Jay, thanks again for coming on. We'll talk to you soon.